We saw a rise in bond yields. I want to ask you, do you think that's why we're seeing the future so much lower right now? You mentioned a poor showing for the 5-year auction.
I think that triggered it. And also the last couple of weeks, we've heard from a slew of Fed members, including the Fed minutes, that reflects a committee that still is not ready to cut interest rates. I think they want to cut interest rates. They're looking for every reason to cut interest rates. They just can't find one just yet. So I think every time we get excitement over the possibility, we get a decline in yields, right, and then we get a reality check, we see a backup in yields, and then you throw in the poor auction, as you mentioned, and we have the 10-year yield back above 4.5%, which seems to be sort of a trigger line.
A sentiment level.
Like in the stock market.
Yeah, it seems to kind of trigger some selling in the market. By the way, Peter, I think you might really just kind of encapsulate the disconnect between the Fed and the market. You're saying that they're looking for a reason to cut. We keep hearing from Fed officials. They don't seem to be telling us that. But I do want to go look ahead to the Beige Book later today. We're going to get some more insight onto just how the economy is doing. What impact do you see the Beige Book having on the markets if just a 10 basis point rise in yields, partly at least, has this kind of an impact on the futures?
The thing that I'm going to be watching most in the Beige Book is, yes, I'll be focused on the inflation aspect. But if there is going to be a trigger for a Fed rate cut this year, it's going to be weakness in the labor market. And I think we've seen some anecdotal evidence. We've seen some things here and there that's pointing to a slowdown in the demand for workers. Not necessarily a notable pickup in firings, but a slowdown in hirings. Okay. So that's one aspect of the Beige Book that I'm going to be most focused on, because if the unemployment rate gets above 4.5%, if we see 4.1, 4.2, 4.3, then you can, I think, confidently say the Fed's going to be closer to cutting interest rates under that scenario.
All right. So for the last couple of weeks on this show, we've been kind of looking at whether it was earnings or the Fed that really seems to be driving the market. It seems like it's the Fed that's driving the market now, with it being possibly tech versus the Fed driving the market. You're looking at inflation when it comes to commodities. Tech's really driving some of this commodity inflation. I'm just looking at it. Quarter to date, copper's up more than 20%. Silver's up almost 30%. A lot of that rise is being attributed to data center spending. So in your mind, this rise in commodities, how does that impact the Fed? How does tech continue to impact the market?
It very much complicates the Fed's job. When you see the CRB index encapsulating a lot of different commodity prices go up. I mean, if you look at gold at a record high, what central banker can ignore what's going on in gold? I think that would be tough to do. And you talked about the other industrial metals. You can throw in iron ore prices that have increased, aluminum prices that have increased, oil prices that are back near $80 in WTI, natural gas prices that have gotten a lift. That makes it a really difficult situation. So even if the Fed wanted to cut, that commodity price lift keeps sort of a bid underneath inflation and makes their job even more difficult. The tech influence, yes, in terms of the demand for copper, building out data centers, the need for raw materials in EVs, for sure that's going to be a factor as well in lifting commodity prices. And we remain bullish and long them.
So in your mind, if you don't mind just giving a one-word answer, is it tech or the Fed driving the market now that we're pretty much done with earnings season?
I'm going to take the easy way out and say both. No doubt tech headline indices, but the 10-year yield back above 4.5%. The rest of the market is now lagging again.